Dollar-weighted rate of return. The dollar-weighted rate of return or the money-weighted rate of return is the rate of interest rate equates the present value of the cash flow from all the sub-periods in the valuation period, including the terminal market value of the portfolio to the initial market value of the portfolio. The cash flow of each sub-period reflects the difference between the cash inflow due to investment income and the contributions made by the client to the portfolio and the cash outflow reflecting distributions to the client. Notice that it is not necessary to know the market value of the portfolio for each sub-period to determine the dollar-weighted rate of return. The dollar-weighted return RDW solves the following. VO equals summation from T equals 1 to N of CFT over 1 plus RDW to the power of T plus VN over 1 plus RDW to the power of N, where CFT is the cash flow for the portfolio, cash inflows minus cash outflows for subperiod T. VO is the initial value of the portfolio, VN is the ending value of the portfolio. Here is the example of dollar-weighted rate of return. As you can see in the solution, $100,000 equals $5,000 over 1 plus RDW to the power of 1 plus $5,000 over 1 plus RDW squared plus $115,000 over 1 plus RDW to the power of 3. In terms of a financial calculator or a spreadsheet, the cash flows are negative $100 as CF0, $5,000 as CF1, $5,000 as CF2, and $115 as CF3. So the dollar-weighted return calculated using a financial calculator or a spreadsheet is 8.078%. In cash flows, the time-weighted average quarterly return for the DEF portfolio is 17.02%. In quarter 1, the calculation is $0.5 divided by $1.0, the return is 50.0%. In quarter 2, negative $0.5 divided by $1.5, the return is negative 33.3%. In quarter 3, the calculation is $0.5 plus $0.5 divided by $2.0. The return is $50.0. In quarter 4, the calculation is negative $0.5 plus 1 divided by $2.0. The return is 25.0%. And the average, the calculation is 1 plus 0.5 times 1 minus 0.333 times 1 plus 0.5 times 1 plus 0.25, and the return is 17.02%. At the end of the quarter 1, the type of cash flow is initial investment and the cash flow is negative $1.0. At the end of quarter 2, the type of cash flow is contribution and the cash flow is negative $1.0. At the end of the quarter 3, the type of cash flow is withdrawal and the cash flows is positive $0.5. And in quarter 4, withdrawal plus ending value is the type of cash flow and the cash flow is positive $1.5. Advantages and disadvantages to alternative rate of return calculations. The advantage of arithmetic average is it is easy to calculate, and the disadvantage is it ignores compounding. Time-weighted advantage is it is not sensitive to cash contributions and distributions, considers compounding of returns through time, while the disadvantage is it requires the market value at the end of each sub-period. The advantages of dollar-weighted are makes intuitive sense as an internal rate of return. No need to know value of portfolio in each sub-period, while the disadvantage are distorted if there are cash contributions or distributions and requires iterative process to solve. Evaluating performance. The answers to these two questions are critical in assessing how well or how poorly the asset manager performed relative to some benchmark. In answering the first question, we must consider risk so that we can then judge whether the performance was acceptable in the face of the risk. The answer to the second question tells us whether the asset manager, in fact, achieved a return by following the anticipated strategy, while a client would expect that any superior return accomplished is a result of a stated strategy. This may not always be the case. Single index performance evaluation measures. In 1960s, several single index measures were used to evaluate the relative performance of many managers. These measures of performance evaluation did not specify how or why a money manager may have outperformed or underperformed a benchmark. The three measures or indexes are the Trainer Index, the Sharpe Index, and the Jensen Index. All three measures assume that there is a linear relationship between the portfolio's return and the return on some broad-based market index. Performance attribution models. In broad terms, we can explain an actively managed portfolio's return performance by three types of action of the investment manager. The first is actively managing a portfolio to capitalize on factors expected to perform better than other factors. The second is actively managing a portfolio to take advantage of anticipated movements in the market. For example, the manager of a common stock portfolio can increase the portfolio's beta when the market is expected to increase and decrease it when the market is expected to decline. The third is actively managing the portfolio by buying securities that are believed to be undervalued and selling or shorting securities that are believed to be overvalued. The bottom line, the investment management process begins with the setting of investment objectives and then process with setting a policy, selecting a strategy, constructing a portfolio, and then evaluating the performance of the portfolio in the context of the investment objectives. The investment objectives of investors fall into two broad categories: liability-driven objectives and non-liability-driven objectives. A benchmark is needed to evaluate the performance of an asset manager. The asset allocation decisions involves determining how the portfolio's investments should be distributed among the major asset classes. The three different types of asset allocation decisions are policy asset allocation, dynamic asset allocation, and tactical asset allocation. Investable investments are classified into asset classes based on the type of risk associated with the investment, cash flows and value, legal and regulatory issues, and sensitivity to economic influences. Investable investments, the four major asset classes are common stock, bonds, cash equivalents, and real estate. To create other asset classes, the four major asset classes can be extended by, for example, separating foreign securities from domestic securities. In formulating an investment policy, clients' constraints, regulatory constraints, and taxes must be considered. Portfolio strategies may be active or passive strategies or some blend of the two. An active portfolio strategy uses available information and forecasting techniques to seek a better performance, and a portfolio that is simply diversified broadly. A passive portfolio strategy involves minimal expectations input and instead relies on diversification to match the performance of some market index. The selection of the specific assets to be included in a portfolio after the portfolio strategy is selected involves producing realistic and reasonable return expectation and forecast, constructing an efficient portfolio, monitoring, controlling, managing risk exposure, and managing trades and transaction cost. The measurement and evaluation of investment performance involves performance measurement and performance evaluation. Evaluating the performance of an investment portfolio requires estimating returns, adjusting for risk, and comparing the portfolio's performance against a benchmark portfolio's performance. Solutions to triad problems. The return in period 1, R equals $9 plus 1 minus 10 over $10 equals 0%. In period 2, R equals $101 plus 5 minus 100 over $100 equals 6%. And the period 3, R equals $1,100 plus 5 minus 1,000 over $1,000 equals 10.5%. The return of time-weighted return is equals 1 plus 0.10 times 1 plus 0.10 times 1 plus 0.00 to the power of 1/3 minus 1 equals 1.21 to the power of 1/3 minus 1 equals 6.56%. And letter B, $10 equals $1 over 1 plus RDW to the power of 1 plus $1 over 1 plus RDW to the power of 1 plus $1 plus 9 over 1 plus RDW to the power of 1. And the dollar weighted return is equal to 6.886%.